Crypto laundering. At first glance, crypto should be the worst possible tool for laundering money. It's transparent, public, and every transaction is recorded on the blockchain. That sounds like a forensic
Mm.
accountant's dream. But for criminals, it's also paradise. Here's why. While blockchain is permanent, identity isn't tied to wallet addresses. That's the loophole. You can trace the money, but not the person. And criminals exploit this gap like artists with a blank canvas. Let's take you inside a typical crypto laundering operation. Imagine a hacker steals $10 million in Bitcoin through ransomware. That Bitcoin sits in a known wallet, tainted, tracked, and unusable for any legal purchase. Step 1. Obfuscate it. Phase 1. Mixers aka tumblers. These services work like industrial blenders. The dirty Bitcoin is split up into tiny pieces and mixed with other users' coins, legit and illegit alike. Then it's withdrawn to new wallets in random intervals and amounts. Think of it as shredding a document, throwing the pieces into a million others and trying to tape it back together. One infamous example is Tornado Cash, a crypto mixer built on Ethereum. It allowed users to anonymize ETH transactions, but it also became a haven for hackers, including North Korea's Lazarus Group, which allegedly laundered over $100 million using Tornado. Phase 2. Chain hopping. Even if a mixer isn't enough, criminals don't stop there. They convert Bitcoin into Monero or Zcash, privacy coins with built-in anonymity features. From there, they might jump to Ethereum, then Binance Smart Chain. Every jump makes the trail colder. Some laundering schemes involve over 20 swaps across chains, making it virtually impossible to follow the money without specialized forensic software. Phase 3. DeFi protocols and NFT wash trades. Here's where things get creative. Decentralized exchanges, DEXs, let you trade without KYC, know your customer checks. Criminals set up fake tokens, swap them back and forth between wallets they control, a tactic known as wash trading, and suddenly the origin of the funds is trading profit. NFTs, even better. A criminal can mint a worthless NFT, sell it to themselves for $500,000 in dirty ETH, and call it a legitimate art sale. No questions asked. In 2022, Chainalysis estimated that $23.8 billion in illicit crypto transactions were recorded on-chain. And that's just what they could track. With mixers, cross-chain bridges, and privacy coins, the real number could be far higher. Art and antiquities. Laundering, imagine hiding millions of dirty dollars in a painting, no joke. Art is one of the most unregulated, opaque markets in the world. No price transparency. No registry, no IDs required. Perfect for laundering. Here's the play. Step 1. Acquire art with dirty money. A criminal walks into an art gallery or connects with a private dealer. They buy a piece, a real Picasso, or just something with a vaguely French-sounding name. Payment? Cash, offshore wire, crypto, whatever. The seller doesn't ask questions. In fact, in many jurisdictions, art dealers aren't legally required to conduct due diligence, especially for private sales under certain limits. Step 2. Inflate the value. The buyer or an associate gets the artwork appraised at an inflated price, sometimes 5x or 10x what they paid. Why? Because the resale value of art isn't regulated like property. An oil painting that cost $500,000 today could be worth $3 million tomorrow, if you say it is. Step 3. Sell it to yourself or a shell company. The launderer then sells the artwork at the new inflated value to a shell company they also control. This creates the illusion of a legitimate business transaction. The money moves across borders, tax-free, under the banner of art investment. Step 4. Store it in a free port. Here's the cherry on top. The artwork doesn't need to hang in a gallery. It's shipped to a free port, a massive tax-free warehouse near airports in places like Geneva, Singapore, and Luxembourg. These facilities hold billions in paintings, jewelry, and antiquities, all behind locked doors. No taxes, no customs scrutiny, no questions. Casino laundering. Casinos are designed to handle huge amounts of cash, fast, and for money launderers, that's a golden opportunity. They're loud, chaotic, and full of legitimate reasons to move money in and out without much suspicion. So how does it work? Step 1. Buy in with dirty cash. The criminal enters a casino with a bag full of dirty money. They exchange it for chips. No need to play right away. The transaction is logged as player funds. At this stage, the casino has no idea if that money is from drugs, fraud, or grandma's inheritance. Step 2. Minimal or fake gambling. To avoid red flags, they don't just cash out immediately. Instead, they place a few conservative bets, a bit of roulette, and a few hands of poker. They want to look like a real player. Maybe they even intentionally lose a bit. It's the cost of doing business. Some even collude with another player. They bet against each other to make it look legitimate, like money is changing hands due to luck, not laundering. Step 3. Cash out as winnings. Now comes the fun part. They return to the cashier, cash in their chips, and walk out with a check, wire transfer, or casino payout slip, all of which look like clean gambling profits. That $190,000 that was once soaked in cocaine residue, now it's clean enough to deposit in a bank. Charity laundering. Charities are built on trust, and that's exactly what criminals exploit.
Yeah, boy.
Here's how the laundering play works, step by step. Step 1. Set up a fake nonprofit. A criminal creates a charity on paper. The name is vague and noble sounding. Hope for Humanity, Global Relief Partners, or Veterans United. They register it in a jurisdiction with lax oversight, fill out the basic paperwork, and maybe even create a basic website. Step 2. Funnel dirty money as donations. Once the shell is leave, they start donating large sums of their own dirty cash. On paper, they're just a generous philanthropist. But in reality, they're washing their own funds through a seemingly righteous cause. Even worse, some charities get real donations and still get hijacked. A corrupt insider, like a treasurer or founder, can skim off the top and reroute funds to fake vendors, foreign bank accounts, or inflated contracts. Step 3. Disperse funds to front companies or projects. Now the launderer gets creative. They send the charity's money to relief efforts in countries with poor oversight, or to consulting firms, media agencies, or research partners who don't exist, or are shell companies they control. On paper, it's all expenses and charitable work, but the money's being cleaned and repurposed. Step 4. Claim tax deductions and build legitimacy. Charitable donations are often tax deductible, so the criminal not only launders their money, they also reduce their taxable income. Over time, their charity builds credibility. They might get invited to events, featured in articles, or partner with legit NGOs, all of which creates more cover for future laundering. Prepaid cards and gift cards. You've probably used a prepaid Visa card or grabbed an Amazon gift card at the checkout lane. For most people, it's a convenient gift. But for money launderers, it's a low-risk, high-speed ticket to clean money. Let's dig into why prepaid cards are so effective for laundering. Reason 1. No ID, no paper trail. Many prepaid cards don't require identity verification. You can buy one at a gas station or supermarket with cash. There's no bank account involved, no name attached, no suspicious eyes. Just swipe, load, and go. This is what makes it perfect for a tactic called smurfing. I talked about it in the previous video, you might want to check that out. But in a nutshell, instead of depositing $50,000 at once and raising flags, the criminal buys 500 prepaid cards loaded with $100 each. Now it's spread out and hidden in plain sight. Reason 2. Fluid and liquid. Once loaded, these cards are accepted everywhere. Online, in stores, and even to withdraw cash at ATMs. They're also easy to sell on gray market websites and forums. Got a $1,000 Visa gift card? You can flip it for $900 worth of Bitcoin or sell it to someone who needs to make an anonymous purchase. 3 typical laundering paths. Conversion. Use the cards to purchase high resale electronics or luxury goods, iPhones, designer bags, etc. Then flip them online for clean cash or crypto. Transfer. Link the cards to a fake e-commerce business and make purchases from yourself, funneling the money into the business account. Stacking. Slowly drain funds into crypto wallets, PayPal, or online gambling accounts where further obfuscation can take place. In 2020, U.S. federal agents broke up a laundering ring based in Southern California. The group used couriers to buy prepaid debit cards in bulk, which were then used to buy iPhones, gold, and even airline tickets. The goods were shipped abroad, sold, and the funds returned via offshore accounts. Authorities traced over $10 million through this method, loan back or fake debt schemes. This one's a mind-bender, and one of the most sophisticated tricks in the money laundering playbook. On the surface, it looks like a legitimate business transaction, but behind the scenes, it's just one person lending themselves money to clean up dirty cash. Here's how it works. Step 1. Set up 2 companies. The launderer creates 2 separate legal entities, Company A and Company B. These might be registered in different countries, owned by proxies, or buried behind layers of shell corporations. But make no mistake, they're both controlled by the same person or criminal network. Step 2. Fake the loan. Company A agrees to loan $5 million to Company B. On paper, it's a business deal. There's even a contract with interest rates, repayment terms, and official signatures. All of it looks 100% legal. But here's the catch. The money B repays to A isn't real revenue. It's drug money, bribe money, scam proceeds. By routing it as loan repayments, the dirty money becomes clean. Step 3. Add layers to confuse investigators. Register Company A in the British Virgin Islands where ownership is opaque. Route payments through a bank in Cyprus. Have Company B pay interest to a consulting firm in Dubai, which then reinvests in a Swiss trust. By the time any regulator notices, the money has changed hands 5 times across 4 countries. Step 4. Book it as legitimate income. Now Company A has $5 million in repaid loans. It looks like a return on investment. The money is deposited in a bank, taxed, and reinvested. Clean as a whistle. Did you enjoy this breakdown? Then please subscribe and hit the notification bell for more.